Before we begin, let me ask you something important. Where are you watching this from right now? Drop your country or your city in the comments because what we are about to talk about is not limited to one nation, one market, or one financial system. The story unfolding around gold and silver today is global, and people from every corner of the world are starting to notice the same pattern at the same time. Whether you are watching from the United States, the United Kingdom, Canada, India, Pakistan, the Middle East, Africa, or anywhere else, the shift that is happening inside the precious metals market affects you directly because it is tied to the stability of the entire financial system. And the reason this conversation is becoming so important is because one of the most powerful financial institutions on earth has just made an admission that changes how investors should be thinking about gold and silver going forward. Today, one of the largest asset management firms in the world made a statement that deserves far more attention than it is currently receiving. This is a company that oversees more than $10 trillion in assets and has influence across nearly every major financial market on the planet. Institutions of that scale rarely reveal their true perspective, unless doing so also aligns with their own financial interests. In other words, when a firm of that size begins openly discussing a major opportunity, it is usually because they are already positioned to benefit from what they believe is coming next. And according to their latest analysis, the forces driving gold and silver higher are not temporary or speculative. Instead, they appear to be structural shifts that could continue influencing prices for years. The report was released by the firm's head of investment strategy for the Americas within their exchange-traded product division. What makes the analysis remarkable is not simply that it discusses precious metals in a positive light, but that it frames the current environment as potentially the beginning of a much larger demand wave. That is a powerful statement coming from an institution that manages more capital than most countries produce in economic output each year. When a firm with that level of research capability publishes conclusions like this, it deserves careful attention. Let's begin with the raw numbers, because the numbers alone already challenge the traditional narrative that many investors have been hearing for years. Over the past year, gold prices have surged roughly 75%. At the same time, silver has experienced an even more dramatic move. Silver surged approximately 148% during the year, and then added another 19% during the month of January alone, even after experiencing a sharp 26% pullback on January 30th. Read those figures carefully because they represent a scale of movement that rarely occurs in large commodity markets. A gain of nearly 150% within a year is not a small rally. It is the kind of explosive movement that typically appears when a market that has been undervalued for a long time begins rapidly repricing. Now here's the part that makes the analysis so significant. After those extraordinary gains, the report does not suggest taking profits. It does not warn that the rally has gone too far. Instead, it proposes that the market may still be in the early stages of a broader expansion in demand. According to the firm's own language, the current surge could represent only the beginning of a new wave of buying, driven by several emerging forces that did not play a meaningful role in earlier precious metal cycles. Among those forces are central bank reserve strategies, the rise of digital currency ecosystems, and the massive technological expansion linked to artificial intelligence infrastructure. Think about the implications of that statement. Gold has already moved above $5,000 per ounce. Silver has more than doubled in value. Yet one of the largest asset managers in history is suggesting that these moves could still represent an early phase rather than the end of the trend. That is not the kind of language institutions use lightly. It implies that powerful long-term demand drivers are forming simultaneously, and those drivers may continue pushing precious metals higher. To understand why this perspective is gaining traction, we need to examine the three major catalysts highlighted in the report. Each of them individually could support a multi-year bull market in gold and silver, but when all three appear at the same time, the combined effect becomes far more significant. The first catalyst involves sovereign debt levels around the world. Government borrowing has expanded dramatically over the last decade, and many of the largest economies now carry debt levels that would have been considered alarming only a generation ago. In the United States, federal debt has risen beyond 120% of gross domestic product. At the same time, annual fiscal deficits continue running around 6 to 7% of GDP. In simple terms, the government spends substantially more each year than it collects in revenue, and the difference must be financed through additional borrowing. This issue is not limited to a single country. Many developed economies are experiencing similar trends. Global debt levels among major nations such as Japan, the United Kingdom, France, and Canada have climbed above 100% of GDP as well. When debt grows faster than economic output for long periods, it eventually raises questions about how that debt will be managed in the future. Governments can attempt to reduce deficits through higher taxes or spending cuts, but both of those options carry significant political and economic consequences. As a result, many policymakers choose the easier path, which is continued borrowing combined with monetary expansion. This is where precious metals enter the conversation. Gold and silver have historically served as financial assets that cannot be created by government decree. Unlike fiat currencies, which can be expanded through monetary policy, the supply of physical metals grows slowly through mining and refining. When investors begin worrying about the long-term stability of currencies or debt systems, they often turn toward assets with limited supply. That dynamic has been visible throughout financial history, and it appears to be resurfacing again today. The second catalyst discussed in the report introduces an entirely new category of demand that did not exist in previous precious metals cycles. The rapid expansion of stablecoins and the broader cryptocurrency ecosystem is beginning to intersect with traditional stores of value. Stablecoins are digital tokens designed to maintain a fixed value, often pegged to national currencies like the US dollar. Over the last few years, some issuers of these tokens have begun diversifying the assets that support their reserves. One of the most notable examples involves the stablecoin issuer Tether. The company has accumulated approximately 140 tons of gold. To put that figure in perspective, a reserve of that size would place it among the largest gold holders in the world. A digital currency company that did not exist 15 years ago now controls more physical gold than many sovereign nations. And this development is occurring alongside explosive growth in the stablecoin sector itself. The total market value of stablecoins has expanded from roughly $28 billion in 2020 to more than $280 billion by 2025. That represents a tenfold increase within 5 years. Projections for the future suggest the sector could reach nearly $2 trillion by 2030 under conservative assumptions, with some scenarios estimating growth toward $4 trillion. If even a portion of those reserves begins incorporating gold as a diversification asset, the demand impact could be enormous. Hundreds of additional tons of buying could emerge from an industry that historically had no connection to precious metals at all. This is one of the reasons analysts believe we may be witnessing the early stages of a structural shift rather than a temporary surge. The report also identifies another pathway through which digital finance could influence gold demand. Instead of relying solely on dollar-backed tokens, investors may increasingly move toward tokenized gold or gold-linked digital assets. These products allow individuals to hold fractional ownership of physical gold through blockchain systems while maintaining the liquidity of digital markets. If such systems gain widespread adoption, they could introduce millions of new participants into the precious metals ecosystem. When you combine these developments with the ongoing debt dynamics in major economies, it becomes easier to understand why some institutions believe the precious metals market is entering a new phase. The forces involved are not isolated events. They are interconnected trends that reinforce one another. And when markets experience that kind of convergence, the resulting price movements can become far more powerful than most investors initially expect. The third catalyst identified in the analysis focuses primarily on silver, and it connects directly to the technological transformation that is currently reshaping the global economy. Unlike gold, which functions primarily as a monetary asset and store of value, silver carries a dual identity. It is both a monetary metal and one of the most important industrial materials used in modern technology. This dual role means that silver demand is influenced not only by financial trends, but also by the rapid expansion of industries that rely on advanced electronics and energy infrastructure. Today, roughly 60% of the silver consumed each year is used in industrial applications. That includes electronics manufacturing, solar energy systems, semiconductor production, and the infrastructure supporting artificial intelligence computing networks. Electronics alone account for around 445 million ounces of annual silver demand, making it the largest single industrial use of the metal. Every smartphone, computer, and advanced electronic device contains small but essential amounts of silver because of its unmatched electrical conductivity. Silver is the most efficient electrical conductor of any element on the periodic table. That property makes it extremely valuable in applications where reliable and efficient energy transfer is required. Manufacturers rely on silver for circuit boards, electrical contacts, switches, and high-performance connectors. When global demand for electronic devices expands, the demand for silver inevitably rises alongside it. One of the fastest-growing areas of silver consumption is solar energy technology. Solar photovoltaic systems rely heavily on silver within the conductive layers that carry electricity generated by solar cells. Over the past decade, the solar sector has grown dramatically, and its share of total silver demand has expanded with it. In 2014, solar technology represented roughly 11% of global industrial silver consumption. By 2024, that share had climbed to nearly 29%. In other words, solar demand for silver nearly tripled its portion of the market within 10 years. Energy researchers expect solar capacity to continue expanding rapidly through the end of the decade. Governments around the world are investing billions of dollars into renewable energy infrastructure as part of long-term energy strategies. Each new solar installation requires silver components, which means the expansion of solar power directly translates into additional demand for the metal. At the same time, another technological wave is emerging that requires vast quantities of advanced computing infrastructure. Artificial intelligence systems depend on enormous networks of data centers to process and store information. These facilities require massive amounts of electrical hardware, including server connections, circuit boards, cooling systems, and communication networks. Nearly every one of those components uses silver in some capacity. Global data center computing power has expanded dramatically over the past 2 decades. Around the year 2000, the total capacity of data centers worldwide was estimated at roughly 1 gigawatt of computing power. Today, that figure has grown to nearly 50 gigawatts. That represents a 50-fold increase in computational infrastructure. Each new data center requires extensive electrical systems to operate, and those systems rely heavily on silver because no other material matches its conductivity. When solar energy installations, electric vehicles, semiconductor production, and artificial intelligence infrastructure are all expanding simultaneously, the demand for silver rises from multiple directions at once. Mines, however, cannot increase production overnight. Mining projects require years of exploration, permitting, construction, and investment before they begin producing metal. As a result, supply often responds slowly to sudden surges in demand. This imbalance between industrial demand and mining supply is one of the reasons analysts have begun paying closer attention to global silver inventories. Certain exchanges and storage facilities have seen their available inventories decline as physical metal moves toward regions where industrial demand is strongest. For example, reports from Asian markets have indicated that stockpiles in certain vaults have dropped significantly, while buyers in those regions are sometimes willing to pay higher premiums to secure physical silver for manufacturing. When industrial users need reliable access to raw materials, they often prioritize supply security over price sensitivity. In other words, a manufacturer producing solar panels or electronic components cannot simply halt production because the metal price increased slightly. Maintaining operations requires consistent access to materials. If inventories tighten, those manufacturers may be willing to pay higher premiums to ensure deliveries continue without interruption. This dynamic has created noticeable differences between prices observed in various markets. In some regions, buyers have been paying premiums above Western paper market prices in order to obtain immediate physical supply. Those premiums reflect the practical reality that industrial production requires actual metal rather than financial contracts. As long as demand for technology infrastructure continues expanding, the competition for available silver supply could remain intense. While industrial demand forms one pillar of the precious metals outlook, another critical factor involves central banks. Central banks are the institutions responsible for managing national currency reserves. Their decisions about which assets to hold can significantly influence global financial markets. According to the analysis, central banks collectively hold roughly 20% of all gold that has ever been mined. During recent years, many central banks have been steadily increasing their gold reserves. This trend reflects a broader effort by some countries to diversify their holdings away from reliance on the US dollar. Historically, U.S. Treasury securities have served as the backbone of global reserve portfolios. Governments purchased those securities because they were considered safe, liquid, and supported by the world's largest economy. However, shifting geopolitical dynamics and rising debt levels have encouraged some countries to reassess their reserve strategies. As a result, gold purchases by central banks have accelerated. In fact, reports indicate that gold recently surpassed U.S. Treasury securities as the largest component of global reserves for the first time in several decades. This development carries significant symbolic and financial meaning. For many years, the international monetary system revolved around the dominance of the U.S. dollar and the perceived stability of U.S. government debt. When central banks begin allocating larger portions of their reserves to gold instead of treasuries, it signals a change in how those institutions evaluate long-term financial security. Surveys conducted among central banks reinforce this trend. In a recent survey, approximately 95% of central banks indicated that they expect global gold reserves to increase in the coming years. Only a few years earlier, the number expressing that expectation was significantly lower. The rapid increase in confidence toward gold reflects a growing recognition that precious metals can provide diversification benefits during uncertain economic conditions. Another detail within the analysis reveals just how much potential demand may still exist. Several major economies currently hold relatively small percentages of their reserves in gold compared with historical norms. For example, countries such as China and Brazil maintain gold allocations that represent less than 10% of their total reserves. In contrast, nations like Germany and the United States hold more than 70% of their reserves in gold. This difference suggests that some countries have substantial room to increase their gold holdings if they choose to align with the strategies adopted by other central banks. Even a small adjustment in allocation percentages by large economies could translate into hundreds of tons of additional gold demand entering the market. At the same time, private investors appear to remain underexposed to precious metals. According to the analysis, private wealth allocations to gold are roughly 50% lower than they were a decade ago. That means the average investor currently holds significantly less gold in their portfolio than investors did during previous periods of economic uncertainty. Exchange-traded products backed by gold represent only a small fraction of total private financial assets in the United States. Their share remains below the levels reached during earlier peaks in the precious metals market. This indicates that many investors in Western countries have not yet fully participated in the recent rally. If that situation changes, the resulting increase in retail demand could create an additional wave of buying pressure. Financial advisors, who have historically focused on equities and bonds, may begin recommending precious metals as a diversification tool if the current trend continues. When large numbers of investors simultaneously seek exposure to a limited supply asset, the price response can be dramatic. Many individuals who have been accumulating physical metals for years often mention that few people in their personal circles are currently investing in gold or silver. Friends, family members, and financial professionals sometimes dismiss precious metals as outdated or unnecessary assets. Interestingly, that kind of skepticism often appears during the early stages of long-term bull markets. Broad public enthusiasm typically emerges only after prices have already moved significantly higher. At present, the evidence suggests that widespread retail participation has not yet fully arrived. Institutional buying, central bank accumulation, industrial demand, and emerging digital finance trends are already influencing the market. But if private investors eventually join those forces, the demand shock could become much larger than anything witnessed so far. Now let's connect all of these macro forces to what is actually happening inside the silver market itself, because this is where the institutional outlook begins to intersect with real market structure. When you step back and look at the complete picture, you see several powerful trends converging at the same time. There is aggressive central bank accumulation of gold reserves, expanding industrial demand for silver from solar and electronics manufacturing, the rise of stablecoin and digital finance ecosystems that may incorporate precious metals, and a global financial environment defined by rising debt and currency uncertainty. These forces together create the kind of structural backdrop that historically precedes long multi-year commodity cycles. At the same time, technical analysts have been observing an interesting formation in the silver price structure. Over the last several months, the market has been consolidating inside a tightening triangular pattern. A formation like that typically represents a period in which buyers and sellers temporarily reach equilibrium before the next directional move begins. As the trading range becomes narrower, pressure builds within the market. When a breakout finally occurs, it often leads to a rapid expansion in price as traders and investors rush to reposition. Some independent analysts studying this structure have suggested that a decisive breakout could lead to a strong upward move if the broader macro forces we discussed continue to support demand. One analyst from RM Capital Analytics, for example, highlighted this triangular formation and proposed that the initial breakout could target the region around $130 per ounce for silver. Beyond that first level, further upside projections have been discussed in the range of $150 or higher if momentum continues building. For many viewers, those numbers may sound unrealistic at first. After all, for many years, silver traded mostly between $15 and $30 per ounce. Even during previous spikes, the metal rarely stayed above $50 for long. But it is important to remember that markets do not remain static forever. Prices are determined by supply and demand conditions, and those conditions can change dramatically over time. Consider what has already happened during the last year. Gold moved from roughly $2,800 per ounce to above $5,000. Silver climbed from the 30s to levels approaching 90 in Western markets. In Shanghai, the price moved even higher, surpassing $100 per ounce at times. These changes occurred far faster than most analysts predicted. Just 1 year earlier, many forecasts suggested gold might struggle to reach $3,000 and silver might reach $50 at best. Yet the market moved well beyond those expectations. This is why experienced investors often remind others that numbers which appear unrealistic today can become obvious in hindsight. During every major commodity cycle, there is a moment when the market begins repricing much more quickly than people expect. Participants anchored to older price ranges struggle to adjust their assumptions, while new buyers enter the market once the trend becomes undeniable. One interesting indicator of the shifting dynamics between physical and paper markets has been the price difference between Western futures exchanges and Asian trading venues. At times, buyers in Shanghai have been paying premiums above Western benchmark prices to obtain physical silver. That premium suggests that the demand for immediate delivery in certain regions is stronger than the supply available at those locations. When price gaps like that persist, arbitrage opportunities emerge. Traders can purchase metal in markets where prices are lower and ship it to markets where prices are higher, capturing the difference. Over time, this process tends to move physical supply toward regions experiencing the strongest demand. As inventories shift, the price relationships between markets may also begin adjusting. Inventory levels on certain Western exchanges have already attracted attention from analysts who monitor physical metal availability. When registered inventories decline while demand remains strong, the leverage between paper contracts and physical supply can increase. In simple terms, more financial claims may exist relative to the amount of metal that is actually available for delivery. Under normal conditions, that structure functions smoothly because most contracts are settled financially rather than through physical delivery. However, if demand for actual metal suddenly increases, markets with limited physical inventory can experience rapid repricing. Prices may not rise gradually during such moments. Instead, they can jump quickly as buyers compete for limited supply. Episodes like that have occurred many times in commodity history when inventories tightened unexpectedly. Volatility statistics already suggest that precious metals are entering a more dynamic phase. According to the institutional analysis, volatility in gold has increased approximately 46% since the start of the year, while silver volatility has surged by more than 100%. Some investors interpret volatility as a warning sign, but during strong bull markets, volatility often accompanies rapid price discovery. When markets move from undervalued levels toward new equilibrium prices, fluctuations become larger as participants adjust their expectations. Historical examples illustrate this pattern clearly. During the 1970s, gold experienced dramatic swings while rising from $35 per ounce to over $800. Silver also experienced extreme volatility during its surge toward $50 in the early 1980s, and again during the rally in 2010 and 2011. Those movements were not smooth upward trends. They included sharp corrections and rapid advances as the market recalibrated its perception of value. Today, the same process of price discovery may be unfolding again. Decades of paper trading, financial leverage, and confidence in traditional monetary systems helped maintain relatively stable price ranges for precious metals. But when the credibility of those systems begins shifting, investors reconsider the role of assets that cannot be created through monetary policy. This brings us back to an important question. Why are many financial advisors not discussing these developments with their clients? The answer may lie in the structure of the modern financial industry. Wealth management firms often generate revenue through mutual funds, managed portfolios, and exchange-traded products that remain within the traditional financial system. Physical precious metals, by contrast, can be stored outside that system. When investors purchase gold or silver and hold it directly, there is no ongoing management fee. Because of that dynamic, precious metals sometimes receive less attention within mainstream financial discussions. Advisors frequently emphasize assets that fit more easily within existing portfolio management frameworks. Yet the institutional research we have been discussing shows that some of the largest asset managers in the world are carefully studying the role of gold and silver within modern portfolios. Another aspect of the analysis focuses on gold's ability to stabilize portfolios during periods of market stress. Researchers examined months since 2020 when the S&P 500 declined by more than 5%. During those months, gold delivered an average positive return of around 2%, while the U.S. aggregate bond index remained roughly flat. This result challenges the traditional assumption that bonds always provide the primary hedge against stock market downturns. In the classic 60-40 portfolio model, investors allocate 60% to stocks and 40% to bonds in order to balance growth and stability. But correlations between stocks and bonds have become less predictable in recent years. In certain market conditions, both assets can decline simultaneously. In those scenarios, gold may provide diversification benefits that bonds do not always deliver. Silver plays a different but complementary role within a diversified portfolio. While gold often acts as a defensive asset during market turbulence, silver tends to respond more strongly during periods of economic expansion and technological growth. Because silver is both a monetary metal and an industrial input, it can benefit from currency debasement while also gaining from rising industrial production.